Hello everyone, Ricardo Nava here, your San Diego mortgage specialist. I'm here today to talk about 5 and 7 year ARMs, which stands for adjustable rate mortgages, versus a 30-year fixed. And the reason why is because I've been getting a lot of people recently asking more and more about adjustable rate mortgages because interest rates are climbing higher. And it is getting a little bit more expensive to buy a home, so people are trying to think of, what are their other options to be able to get a lower payment. And obviously, adjustable rate mortgages can give you a lower payment. That's what they were designed for. But a lot of people are a little bit weary because they associate the mortgage crisis of '07, '08 with adjustable rate mortgages, and people's payments doubling and tripling, and then they can't afford their home and they go into default, foreclosure, etc., etc. So I'm here to kind of clarify some common misconceptions, to kind of give you guys some tips basically on, does it make sense for you to look into a 5 or 7 year ARM, and what exactly is a 5 and 7 year ARM versus a 30-year fix. Because for some people it's not going to make sense. You're better off going with the 30-year fixed option. But for some of you it does make sense actually to look into a 5 or 7 year ARM. So first of all, I already explained that ARM stands for adjustable rate mortgage, right? Well, a 5 to 7 year ARM, basically what it is they're two different products. A 5-year ARM means that it's fixed for the first 5 years, and then after the 5 years, it can change according to the current market at that time. Same thing with a 7-year. A 7-year ARM is fixed for the first 7 years, and then after 7 years, it can adjust according to the market at that time. One important thing to know is that doesn't mean that after 5 years or 7 years, it's automatically going to increase. That is not the case. Because if 7 years from now or 5 years from now, interest rates are actually lower than right now, then what's going to happen is after that fixed term is up, your payment could actually drop and your interest rate could actually drop. Yes, that is possible. It is also possible that it could go up, or it's possible that it could stay the same. It all depends on how the market's going to be, and it's completely impossible to predict what the market's going to do 5 to 7 years from now. Now, let me explain the difference between today's adjustable rate mortgages and the old adjustable rate mortgages that were back in 2007, 2008. Back then, people were getting what's called interest-only loans and also negative amortization. So interest-only basically means that on your payment, you're only paying the interest on your loan and you're not paying anything to reduce the principal balance on your loan. So basically, a traditional payment, part of it goes to the interest and the other part of it goes to reducing your principal balance. So that over the course of however much time, your balance is actually going down as long as you make your payment on time, right? Well, an interest-only loan is not the case because you're only paying the interest and the balance is staying the same, all right? And now a negative amortization loan, what it means is that the balance is not just staying the same, it's actually increasing. So the longer you have the loan, the higher balance you actually get. So when you think about it now, after like 10 years, your loan could be way higher than what you started with. That doesn't make any sense, right? So nowadays, we don't really offer negative amortization loans anymore because there's a lot of laws that have been put into place ever since that happened to be able to protect consumers like you. So nowadays, every 5 and 7, I wouldn't say every, but the 5 and 7 year ARMs that we use, they are fully amortized and they're not interest only, which means that when you make your regular payment, part of it's going towards interest and part of it's going towards reducing the principal balance. So even if you have a 5 or 7 year ARM, for the first 5 or 7 years, you are paying down your principal and your rate stays fixed for that amount of time. Now, if you have a stable job and a stable income, and you know that 5 to 7 years is a pretty good chance that you're not going to have a hard time qualifying for another loan, then yeah, it does make sense to at least take a look at a 5 or 7 year ARM, because you can save a lot of money over that time. Just to give you an example, hypothetically speaking, the difference from like a 7-year arm and a 30-year fixed, it could be, several $100s in monthly payment. So let's say you're taking a 7-year arm. Over the course of those 7 years, you could be potentially saving thousands of dollars. So let's say, hypothetically speaking, that over those 7 years, you can save $10,000 by taking that 7-year arm, right? Well, a lot of times they do cost. You get charged points for taking an arm, but let's say it costs you $2,000 to take that 7-year arm, right? So you pay that $2,000 up front at closing when you buy your house. It's part of your closing costs, right? Now, at the end of the 7 years, when it's time to refinance, you've saved $10,000 over the course of those 7 years. You pay $2,000 up front to save $10,000. You have a net savings of about $8,000. Yeah, that makes sense. That was a great investment. Now, at the end of that 7 years, you will have to, you don't have to, but it's recommended that you refinance at that point and get into it. If rates are great, then get into a 30-year fix at that point. You dropped your rate, you dropped your payment, and now it's fixed for the life of the loan. If rates aren't that great, then you can refinance into another 7-year loan. And yes, you can do that again. All right? Now, the risk obviously associated with that is, well, what if you lose your job between now and then? What if you start making less money? So those are all things that you have to take into consideration. Do you want to take the risk of possibly not having a job in 7 years and not being able to refinance? Now, for most people that doesn't happen, but for some people it does. So those are all things that you will have to take into account when you're deciding whether or not to choose between the two. Now, FYI, the 5 and 7-year arms are usually reserved for people with good credit. So if you're barely meeting the minimum required credit scores to buy a house, then your best option is going to go with a 30-year fix, because to get a 7-year arm, it's going to cost you a lot of money. And not only that, but the difference in interest rate might not be that big of a deal. But if you're someone who has over 700 credit and you're buying a house, then it might make sense to actually look into what a 5 and 7-year arm would look like, because they are a lot safer than they were before. They're a lot lower risk. There is still some risk involved, but the only risk involved is basically you losing your job or not being able to refinance, or the real estate market tanks completely, and then your house is worth way less than what it was worth when you bought it. But those are all things that are, hypothetically unlikely to happen. So just wanted to kind of give you a brief overview. If you want to know more, contact me, let me know. You can post a comment, send me a direct message onto my page, and I would be more than happy to kind of go into it more in detail with you, show you what your options are. If you are thinking of buying a house, let me know, and I can show you what different loan options you have, not just 5 and 7-year arm, 30-year fix, but there are other options out there. So thank you so much for listening, guys. Have an amazing day, and God bless.